Oh, I am so excited to be here. I feel a bit like Madonna with this thing on, but I promise you there has been no cosmetic surgery to my detriment. So before I start, I just want to say thank you to the New Jersey Business and Industry Association. I very much appreciate the invite, and I want to say thank you to Kevin Morrison for the invite as well. He also works at JP Morgan. So as I'm sure some of you know, JP Morgan and New Jersey actually have pretty long history. So in 1881, JP Morgan had Thomas Edison electrify his house and then his office building and then the city of New York. And that, of course, happened here in Edison, New Jersey. So a lot of history there. To this day, New Jersey is home to more scientists and engineers per square mile than anywhere else in the world. So those innovations that happened 200 years ago are still very much relevant today, and there is a lot more to New Jersey than just Bon Jovi. So I wanted to discuss today what's happening, sort of with the U.S. economy, supply chains, financial markets. I would kind of sum it up as just sort of breaking the cycle. So what we're trying to do here, what the Federal Reserve is trying to do, is they're trying to break the cycle of inflation without breaking the economic cycle, and that's creating the difficulties that we're seeing today. So let's just discuss what happened, in 2020, 21, 22. Essentially, what created the environment we're in today was the pandemic. So we had essentially too much money chasing too few goods. So we shut down the U.S. economy due to healthcare policy. Whether that was the right choice or not, one could all debate that. But essentially, we decided we would put in lots of financial stimulus, fiscal stimulus, monetary stimulus, in order to support, the labor market, consumers throughout that difficult time. Again, no one really knew exactly what was going to happen with the pandemic. And at the same time, we had broken supply chains. So the result was inflation as the price of goods rose pretty sharply, and also services as well, particularly when services reopened, leisure and travel, all those sorts of things. So this created this inflationary environment. So where do supply chains stand now? In the United States, they're almost back to normal. They're relatively close to being fully healed. We can measure that with supply chain pressures indices. There's some produced by several banks. There's also some produced by the Federal Reserve. And we've seen a notable healing in supply chains. I think that will continue to happen, particularly with China's reopening. I think that was kind of the last segment. Supply chains will continue to change over time, and I think domestic onshoring will continue to be a trend. But for the most part, the worst of the pandemic impact is probably over, and we've actually seen goods prices come down pretty noticeably. On the services side, that's the difficult part, right? And I'll talk about that in a minute. So this has led to this environment where we have the Federal Reserve trying to raise interest rates in order to bring down inflation. And they're trying to get the economy sort of back to normal. And that's creating this very, very difficult 2022 for financial markets where stocks did not do well, bonds did not do well, and that 60-40 portfolio that most people have didn't really provide the offset or the diversification that it should have. This year does look a little bit better, which I'll talk about in a minute. But that's what led to this environment. And the downside of this environment is, of course, the Fed taking it too far, right? And it's very often the case that you have a policy overshoot because there is long and variable lags with monetary policy, and it often can take 12 to 18 months before you really see the impact. But they've learned in the past that stop and go policy where you raise rates and then you lower rates and you try and get exactly the right recipe to get inflation down didn't really work. So when the Volcker era started, they decided no more stop and go. We're going to raise them really quickly and we're just going to hold them there and see what happens. And unfortunately, in the 70s, that did lead to a recession. So that's the risk this time around as well. But it doesn't happen immediately, and it happens in different sectors at different times. So you've seen it in the housing market, probably most noticeably, mortgage rates going up to north of 6%, and you've seen home sales kind of come down. Prices have held in there okay. There's a lot of very limited inventory, which I think helps out the housing market, but you're starting to see it there. You're starting to see it kind of occur in other areas, but you really haven't seen it happen in the labor market. Now, the labor market is actually usually one of the last kind of segments to sort of turn over. But right now, if you were going to ask me, is the economy in recession, I think the answer is no, very clearly no. We just added 311,000 jobs today. Wages are still relatively strong, and these are good things, right? We want the economy to hold in there as the Fed raises rates. The difficulty with that is that if the economy continues to hold in there, then inflation has a higher likelihood of becoming ingrained in the economy, and that makes the Federal Reserve feel obligated to go further, right? And that's why it's a difficult environment for the equity markets right now, because they're trying to figure out just what is the right balance, how does this all turn out, and that poses some difficulties. I will say when you look in the past, it's very difficult to have such an aggressive rate hike cycle and not end up with a recession. So if you look at leading economic indicators, the yield curve is one that has a really good track record, but there's many other ones, and the stock market is one of them. If you look at it on a year-on-year basis, so you compare where it is this year to last year, it's in deeply negative territory and suggests that you could have a recession in the next 12 months. So far, that has not been the case. But I think that is the potential risk. Now, that's the bad news, okay? But there's some good news. The good news is we are not starting from a position of excess, right? So if you look at household debt service levels, corporate debt service levels, they're quite low, almost historically low. So corporations are in good shape, consumers are in good shape, and those are the kind of excesses that become real problems when you do have a recession, right? If you think of the global financial crisis, what was the real issue? Well, we had banks had tons of debt on their books, and so did consumers. They had a huge mortgage debt. That's not the case. So if you think about the economy as like a person or a patient, those that are most healthy when they get sick tend to recover faster, right? And those that have pre-existing conditions where they have a lot of debt and they're not very healthy, and then they hit a kind of sort of hiccup like this or a health issue, it becomes much more severe. So the good news is right now, consumers look relatively healthy, corporations look relatively healthy, and banks look much more healthy. And I know there's some things that happened today, if you read the news, Silicon Valley Bank, but those are generally probably regional issues, right? So not every bank has the same amount of liquidity. Some are not considered systemically important, and particularly that bank was exposed to crypto and some of these other things that make it a little bit more difficult. But in general, that should, if we do have a recession, help to mitigate the damage. The other thing is that you're seeing an acceleration of growth outside the United States. So what you're seeing is that everyone thought that Europe was going to have this horrific winter, partly because of the Ukraine and Russia war. That really didn't come to pass. They had an extremely warm weather. They had tons of natural gas storage that they had built up in preparation, and they skirted a recession. And if you think of like the weather here in New York, I think we had 330 some days without snow, which is extremely unusual, but it helped out Europe. The other thing is that China is reopening, and I think people weren't certain that they would abandon their zero COVID policy, but they've decided to do that. They've taken a very different approach this time. And if you can see it in the economic data in China, it's picking up very, very rapidly. So if you think about the situation they're in a very similar position that the United States was in 2021, and particularly the back half of 2020 as well, where you have this rapid return to kind of normal. In the United States, we had 33% annualized, I think it got revised to 35% annualized GDP growth in one quarter when we reopened. So think about what will happen in China when they do that. And that is a very important driver in the global economy. It's not necessarily that relevant to the United States economy, but they represent, I think, something like 20% of sales for Europe. I could be getting that number wrong, but it's a significant portion of sales for European companies. And it does present an opportunity because, one, it helps provide a tailwind to growth, and I actually think that's potentially what we're seeing now and what's making it kind of more difficult for the Fed. But it also presents an opportunity for investing, right? So Chinese equities, relatively attractive valuations compared to where they were from, and particularly European luxury goods and travel are highly exposed to it. So if you think of a company like Louis Vuitton, it's actually up 45% over the last year. S&P Global Luxury Index is also up double digits, which kind of goes against the narrative of this constant recession, right? So there's opportunities out there, and I think you have to be kind of cognizant that the United States is not necessarily in the same position as Europe or China, particularly China. They are in the position we were, where money supply is growing rapidly. They're providing stimulus and they're reopening at the same time. So that is an important tailwind to global growth, and I do think that will help out Europe as well. So when it comes to the stock market, and I realize that may not be at the forefront of everyone's mind here, but I just want to talk a little bit about what traditionally happens during recessions, because I think it helps you have a good mindset when these things occur. Normally what happens is when you have a drawdown and like a normal stock market correction and there's not a recession, the average drawdown is about 24%. Okay, what did we see in October last year? 25%. When you do have a recession, the average drawdown is about 31% or a little bit higher than that. And it's a little bit skewed. Global financial crisis was very significant. Tech bubble was another very significant one where you had a lot of companies without earnings. In this case, we do have a lot of tech companies with actual earnings. They've become, Apple's the new Walmart kind of thing, Amazon, etc. So I don't think that that's the case. So the reason I talk about this is, one, the downside appears to be somewhat more limited, okay, because we already priced it in 2022. Maybe not completely. I'm not saying that it couldn't go down from here, okay, right? I mean, 30%, could it be that? So, yes, maybe. If you have a recession, you could have that. But you have to factor in that we priced it in pretty quickly. So, and I think there's a very good chance that we priced it in October 2022, and that will be the low that kind of holds. So I think the market has de-risked a decent amount well in advance. And why did it do that? It's really unusual because normally the stock market would bottom about halfway through recession. But this time around, you have the second potentially engineered recession in a row, right? So we engineered a recession with COVID. We are engineering a recession this time to get rid of inflation. And it's extremely well telegraphed. The Fed told us what they were going to do, so the market moved well in advance. And I think that's just an important thing to keep in mind. The other thing I want to point out about traditional patterns in the stock market is that the performance, the 12 months after its bottom, is normally very, very strong in the 1 year after. So if you go back to the past recessions and you look back, say, like 9, 10, 12 recessions, the average return in the 12 months that follow that market bottom is about 41%. So recoveries happen very rapidly and very quickly. Is this what we're seeing so far in January? I think it's maybe too early to say that, but I bring out the point because when we see these pockets of volatility, I just think it's important to remember that these downtrends are often followed by very sharp uptrends afterward. So timing the market is a very difficult thing to do. I think there are lots of things that you can do in this environment. This is probably the best returns in a decade on fixed income. You can get relatively risk-free high yields right now, and not just in T-bills. I know a lot of people are in T-bills. You think you can get 5% or 4.5% or whatever it is with relatively little risk, but there's also alternatives like preferreds. They're a little less risky than common stock, but a little more risky than a treasury bill, but they have returns of 8 or 9%. And when you think of the stock market as well, just in general, just to get back to where we were, if you did it in 3 years, which I think is a realistic time frame, right? Will the stock market be back to the high it was in 3 years? I think you could say, yeah, that seems reasonable. It needs about 20-some% to get there, 30%. That gives you an annualized return of about 7 or 8%, which is still better than T-bills. So I think there's opportunities to keep in mind that, all of this noise is pretty much exactly that, right? If you have a long-term investment time horizon and you're not retiring in 2 to 3 years, it's fun to follow this stuff. It's fun to try and take advantage of those opportunities, but a lot of it washes out over time, and you can really see that in historical returns. So if you think of go way back into the 1980s, every single year, the stock market will experience 10% declines, 20% declines. The 20% are pretty rare. They're almost always associated with recession. 10% is not rare. It's really common to see 10% down in the stock market in any given time period during a year. But 74% of those years end the year positive, right? And that's why you invest over the long term, because over the long term, America's innovation, the companies that are profitable, tend to succeed, just like Thomas & Edison and JP Morgan did in the past, and everyone associated with the New Jersey Business and Industry Association. With that, I have 40 seconds left. I think we're going to do Q&A later. I'll just talk about a couple of the opportunities we do see out there. We think that bonds are back. I mentioned bonds. Clearly treasury bills are an option, but preferreds, IG corporate are also an option. The other areas that we like, I mentioned Europe. We do think China makes sense. If you have aversion to China, There are pure plays, or relatively pure plays, through Europe using luxury and travel goods. We also like small cap stocks. Those tend to be the ones that suffer the most when you do enter a recession, but they recover the fastest. So when that opportunity comes around, I wouldn't ignore them. Also, I think dividend growers are a great example. There's something called the S&P 500 Dividend Aristocrats Index. If you line it up with the NASDAQ, which is what everyone talked about, right? How the NASDAQ has done famously well. Well, since before the pandemic, starting in 2020, and you compare them where they are today, the NASDAQ has only beaten it by 5%. So those dividend growers grow steadily over time. They are more like a Warren Buffett portfolio. And I do think if you're nervous about some of this volatility, that may give you an option to kind of phase in over time with a little bit less volatility and risk. With that, I see a whole bunch of zeros on that board back there. And I will wrap things up and take your questions later. Thank you.